Hello, everyone. My name is Gabrielle. I work in marketing for Madrona Financial and CPAs. We are so excited to have you all here for the third webinar in the Business Owners Playbook series. Welcome back to those that joined us last week, and hello to the newcomers. So today we'll be discussing how to value your business and evaluate buyers. If you have any questions, please feel free to submit them to the Q&A tab below, and the speakers will go over them at the very end. So let's get started. Take it away, Brian.
All right, thanks. So you can see here some of the things we're going to be discussing today. I'm really excited about today's because when we talk about business succession, I mean, the first question is, well, how much is my business worth? And it's like, well, it's a little bit more to it than that. It's not like I can look it up on Zillow or on Yahoo Finance and say, well, it's worth $100 a share, or whatever it is. So very different here. So many more combinations and permutations of answers. So we're going to do our best to try and squeeze this into the time that we have today. These are some of the topics here that we'll be discussing. But I want to kind of get into it today because there is a lot of material. Here's the two handsome guys presenting all this information. You'll agree with me there, right, John?
One of us. I'll let you debate who.
Okay, all right. One of us handsome. All right, we'll go with that. All right, so I think most people that have tuned in know a little bit about my background. If you need more, go to madronafinancial.com. And then Chinook Capital Advisors. We've gone over this slide in previous webinars, and so I won't spend any time on that. So we can get into our discussion today, which is types of valuations. And before we started, John, we were kind of discussing about it's interesting in this world. Sometimes you want a very low valuation. Sometimes you want a very high valuation. Sometimes there's people on both sides of the coin. One wants high, one wants low, depending on your objective. So let's start with the formal valuations. There's so many reasons to value a business that you're not even selling. So maybe, John, you could kick it off with discussing some of that, and I'll interject a little bit on the first one and a couple of them here.
Yeah, sure. So, if you own a privately held business, often, we get asked, well, what's my business worth? What's the valuation? And but sometimes, we get asked, well, I'm going to be gifting shares to a family member, or we have three partners in the firm, and one of the partners wants out, so we need to value the business to buy out that partner. So you always have to ask yourself, well, what's the context and what's the purpose of the valuation? And you're right, Brian. Sometimes, if you were going to be creating a trust and giving 10 or 15% of the company to the trust, and that trust was going to be for your kids or grandkids, you'd want a very low valuation to avoid a taxable event. Generally, valuations for gifting between partners, for ESOPs, anything related to the IRS, that valuation is going to be done by a certified business valuation expert, and someone with credentials, and they're going to follow a methodology to create a paper trail to justify the valuation. And it's a little bit of a wink wink. I need a very high valuation or a low valuation because there's a lot of I guess, scope that the evaluator has in terms of picking which methodology that he might use.
Yeah, let me interject there, John, with a question to you that I think I know the answer to. If you had 10 different companies value a particular firm, how many different valuations would you get?
You would get 10.
Oh, wow. I actually knew the answer to that before I asked the question. So yeah, there's your, it depends on, beauty's in the eye of the beholder a little bit.
Yeah. And you wouldn't knock let's say a professional business valuation firm might say, hey, we're going to look at your profitability over the last 3 years or the last 5 years to come up with an average profitability. And, the IRS or no court is going to argue that that's an invalid methodology. Now, the flip side is, if you were to ask for what is the value of my business if I were to sell it today,
Mhm.
and you were talking to an investment banker, our lens is always to what is the maximum value that we can
Right.
get in the market through, a bidding process, right? So going to the market, talking to bona fide buyers and getting multiple offers. And so through the M&A lens, we're really looking at the maximum value. And I'll go through on the next slide here the different methodologies there. But I think it's important when you talk about valuation, what is the context, what's the purpose of the valuation, and who's doing the valuation work.
Yeah, if I had to break it down, I'd say the formal valuation is a little bit more of an art, and the M&A, highest bidder kind of bidding war is more of a science. It is what it is. So, and we could certainly spend a lot of time talking on that, but it's very important to understand what's the purpose of your valuation, and to understand that there are many purposes potentially during the lifetime of a business where you might need valuation help. So we'll go to the next slide. The different types of approaches that one could make. I think about even let's use a real estate analogy. You might have a tear down in the real estate's worth, what the land value is worth, just kind of an asset approach. And then we'll talk about the analogies for real estate after that. But go ahead and take it on the asset approach.
Yeah, sure. So I guess three, primary valuation methodologies: asset approach, income approach, market approach. On the asset approach, that's really going to be for very asset-heavy businesses. So, we worked with a kind of an earth-moving excavation business. So they had a ton of equipment, and say their EBITDA margins were low, maybe 5 or 10%, but the value of the equipment was very high. So if you were to say, well, based on a EBITDA basis, the valuation was low. So in this case, the asset value created a higher value. The replacement cost, if you were to go out and buy that equipment, it was worth more than the cash it was generating. So there's other manufacturing businesses where maybe the AR plus the inventory plus the assets are worth more than the cash flow. So I would say maybe I don't know, maybe 10 to 20% of our companies that we look at, we're really using the asset approach maybe as a floor for the valuation, or doing the heavy work on valuing the assets.
Yeah, and I think farms in that respect, sometimes the farming entity isn't very profitable, so it wouldn't be on the income approach, but it's worth the value. Farmland is worth what it's worth on an asset value. The income approach, that's where we're looking at present value, future cash flows. And this is a little more difficult, as you mentioned here, because we're trying to figure out what it's going to do. Now, this is an approach used in my real estate analogy for commercial real estate. So commercial real estate, what's it worth? Well, tell me what the cash flows are going to be the next 10 years. You have a long-term lease, is a lessor quality payer. If I know what that is, I don't even have to drive out and look at the building. I can almost tell you what it's worth looking at a tax return, just based on discounted cash flows. So there's a real estate analogy, but now maybe you could take over the business analogy.
Yeah, income approach never used for businesses. So yeah,
Mhm.
it's very, very hard to predict future cash flows. You'd have to argue on the cost of capital, the discount rate. Maybe for large public companies, you could use that. Or if you had a business model that had, I don't know, maybe long-term contracts or subscriptions, you might try to build a DCF model. But for manufacturing and distribution, business services businesses here in the Pacific Northwest that we work with, it's very hard to we're lucky to get a 1 year budget with our clients.
Mhm.
So anything beyond a year is really a best guess. So the income approach is really hardly ever used, and so that really leads us to the market approach. And the market approach is pretty simple, but we have databases. We pay for Cap IQ and PitchBook and other similar databases, where we're able to get the multiple of adjusted EBITDA in a range and predict, hey, if we were to go to market today, or if we were to go to market in 6 months, based on our market observations of other similar transactions in your industry, we can predict what a reasonable valuation range would be for your business.
Yeah, the real estate analogy I came up with there is like your principal residence. You might look at a house and go, well, it's 3 bedroom, 2 bath, it's worth X. Oh, but it's in downtown Bellevue. Well, it's worth a lot more. It's based on the market. The market's going to dictate that. If that's, in North Dakota, it's not worth a fraction of what it is worth there. So it's not an asset approach, it's not a rental income approach, but it's what the market bears. And you're right. And then this was where, of course, the really good accounting is so important. Historical accounting, we're going to get into some of the nuances there, but to get to the market approach. So multiples, that's a very interesting area. We talk about EBITDA and what's a business worth. Well, it's generally worth a multiple of that figure adjusted, as we talked about in previous webinars. But here's the big one. I think a lot of people are very interested in this slide as to what would make my number bigger, because a couple notches up to the right on this where you get a premium versus a couple notches down, and the discount can make a world of difference when you sell your business. So let's start with the discounted areas there and go ahead and take that, John.
Sure. Yeah. So, for business owners, I mean, we can look at really empirical data, and we can get a range of EBITDA multiples. So, for example, the range could be 4 to 6, 5 to 7, 6 to 8, 7 to 9, 8 to 10, right? So usually when you're talking to any business owner in their industry, they're just immediately, well, I'm obviously at the highest end of the range, right?
Yeah.
And so then we have to say, well, what are the what are the things that differentiate businesses within that range? So this is not a comprehensive list, but it's just to give you this slide and the next slide just gives you a flavor for that. So for example, things that could bring down, or you would be at the lower end of the range, smaller businesses are valued lower than larger businesses. It's just, they're harder to scale. They're more sensitive to, changes with your customers and suppliers, et cetera. So it's just EBITDA multiples for businesses, say under $1 million of EBITDA, are lower from a range perspective than larger businesses. Any year to year inconsistent margins. How much pricing power do you have in your business model? Is there seasonality or cyclicality? We spent a lot of time in the previous seminar on owner dependencies, right? Are you the business? If you weren't there, would the business still run? Is there a leadership group in place to take over all of your responsibilities kind of seamlessly? If your goal is to leave the business, real estate issues in terms of, are you paying a fair market value for your lease if you own the real estate? And any type of earnings volatility. It's always good to be selling a business that's growing, but with COVID and higher interest rates and supply chain issues, labor issues, I mean, we've been seeing a lot of earnings volatility for medium-sized businesses here over the last, I'd say the last 3 years for sure.
Yeah, the comment on that is just today I got 2 feeds, emails from somebody trying to market financial planning firms, investment advisory practices for me to buy. And I'm looking at these things going, wow, you're not even grossing $1 million. You have all the clients know you as this owner's going to sell and go away. I just looked at that and they were so small that there's no business here. They're grossing, I don't know, $250,000 gross. So what's your net, and so all these things that go into that, I was looking at that going, you guys don't have a business. You had a job, you're going to retire. take a nice vacation and find somebody else to take those clients, because I can't imagine anybody that watches this is going to go, oh, I need to buy that business, give this person lots and lots of money. Oh, and they wanted top dollar. They wanted the high end of the multiples. They wanted that close to 10 EBITDA on this not business. And so I see this all the time, and I just shake my head, but good luck to you. I hope things work out well. So let's
Right.
go to how, if I have a business and I'm not that one, how I can get a premium for that.
Sure. Yeah. Again, so not a comprehensive list, but very recognizable, longstanding brand, a market leader. Customer concentration is always an issue. So, if your largest customer is, say, less than 20% of your revenue, that's good. When you get into the largest customer is 30, 40, 50, 60% of your revenue, then we really need to look at, okay, well, is it one customer, or is it, multiple buying decisions within that customer? Are there long-term agreements in place? How sticky is it? Are there partnerships that make that relationship sticky? So in especially on the financing side, I mean, banks just cringe over customer concentration. So sometimes we'll meet a business owner and great margins. It's growing. It's a premium in all aspects except customer concentration. So we would say, hey, maybe it's worth, let's spend 1 or 2 years to grow your other customers and maybe less of an emphasis on this one customer. Customer concentration, if you own a business and you have a great relationship with your largest customer, keep it. If you never want to sell, there are no customer concentration issues. It's only when you want to sell that really comes into the spotlight. But yeah, repeat customer base, healthy margins, growing. These are all pretty basics. Strong supplier relationships. The management team, can't emphasize that enough. And we're just coaching a business owner and asking him, well, what do you want to do after you sell the business? Well, I'd like to be a consultant, and I don't want to run the business. So we're talking about management meetings, with potential buyers, and we're saying, hey, well, if your message to these buyers is that you don't want to be there, we really need, your team to be in these meetings to talk about, how much value they add to your business and how they get things done and how important they are. So that, in the buyer's eyes, he creates a picture that, oh, yeah, this owner is selling, but he has a really strong management team behind him to run this business. So having that management team, and then having the courage to bring them into the process and meet buyers is another thing that's going to really create a premium valuation. Growth opportunities, not to be underestimated there. We spend a huge amount of time on growth opportunities, and I have a joke with one of my clients right now. I said, the biggest problem in this business is you. And I say that because he's the one that's been stopping growth. He is the growth stop officer because, he's already, he's very wealthy. He has a lifestyle business. He's taking, say $1 million plus a year out of the business. He has no motivation to grow whatsoever because it's a lifestyle business. But, there's new markets, there's new customers, there's new products, all these opportunities, but he just doesn't want to work harder to grow the business. So, he's the growth stop officer, I guess. And and that's the opportunity. And a business, a privately held business in the hands of somebody who really wants to step on the gas pedal. And that's what a good investment banker does, is really articulate those growth opportunities so that the buyer has that vision and can execute on those. And those, again, these are the characteristics that are really going to push the valuation to the right and be at the higher end of the range.
And certainly some of these are more important than others. I think about my financial planning business again. People want to know about that management team and key employees if I were to sell, which I'm not, but if I were, real estate, not very important. I can do this from anywhere. So, there's certain things that are super important, certain things that are less important. But you're also right about, and we're going to talk about that in a slide coming up. As a buyer, I want uncertainties removed, and so the more uncertainties I remove, the better. I also want to think that this business is going to grow because I'm going to be buying it at a certain rate of return, essentially, and that rate of return is not the end all be all. I doubt very many of your buyers are content with a 5, 6, 7, 8, 9, 10% return. It's just they aren't. They want a good deal when they go in. They want to know they can grow that bottom line so they can get those numbers way up. So we'll go to the next slide here. Some of the drivers to valuation. So a lot of this we have to look outside of just finances. I think in my experience, a lot of people that own businesses, they just focus on the financial profile. You have some other things here, but let's start with that financial
Yeah,
profile.
so this is an example of a slide for an outsourced IT service business, or a outsourced consulting business, or a staff augmentation business. So it's, again, you have, EBITDA. So let's just say EBITDA is, $3 million. So the EBITDA is solid. But then what are the characteristics of the business that are going to push this to kind of the higher end of the range? So it's, what's the growth rate, the customer concentration percentages, what's the EBITDA margin, how many different lines of businesses do they have? Are they focused on a specific vertical, like, it could be healthcare or consumer? Do they have large scalable customers that are operating across the US or different countries? How good are they retaining customers? What are customer satisfaction scores? In terms of the metrics, what are the bill rates, utilization, the number of billable consultants, and then do consultants have, certifications or specializations? And then, the management team, where are they located, and turnover. So again, we would customize this for really any industry. So we would look at that industry and we would say, hey, in your industry, what are the valuation drivers, and what are the questions that buyers are going to be asking, and so that we can get our arms around all the data and answer these questions in advance.
Yeah, I really appreciate what you just said there, because as a buyer, we're focused on selling a business here, okay, business succession. But for every seller, there's a buyer, and it's so important to put yourself in the shoes of that buyer. And if I'm looking at a business to buy, and somebody came to me and I said, okay, share with me some data, and you had all of these things identified, looked at, reported on something, some comment on every one of them, I would essentially be blown away as a buyer. And I say, wow, this is first class. I like what I'm seeing here. They're putting the stuff out. They anticipated my questions. They have the data, the metrics, all this stuff. I am feeling very comfortable, as opposed to somebody says, you want what? You want some, I'll give you a tax return. What else do you want? And so, have you had some feedback from when you do start out of the gates with all this kinds of information to that potential buyer?
Yeah, we've just learned the hard way. So, we kind of know what questions are going to be asked, and yeah, but it's good because we can work with our clients, and often, if we'll ask the clients, well, what's your customer profitability analysis? And they're just like, we've never done that, but that's okay. Well, let's, give us the data, and let's build it together, right? So in a way, we become, like an outsourced CFO sometimes for our clients, to help them to create this data where it doesn't exist.
Right. So let's get to a big question here, because this is going to dictate a lot of the terms, the price, the path, and so forth. Who is going to buy your business? So we'll start with the strategic buyers. Go ahead with that, John.
Yeah, sure. I mean, this webinar is really two webinars. So the first one was really a deep dive on valuation and EBITDA multiples. The second half is really, I really want business owners to understand that you may think you know who the buyer of your business is, but based on my experience, you don't, because there are literally thousands of potential buyers for your business, And it's really important that you get in front of, the ones that make the most sense, because they're, the value is the beauty's in the eye of the beholder, right? Your business might be worth a lot to somebody that you just don't know that that value is there, because maybe they've been trying to break into the Pacific Northwest market for a number of years, or you have some customer relationships that are valuable to them, or you have some supplier relationships, or there's just something that you have that makes their business better. And so, until you go out and talk to all the potential buyers, that value is not going to be realized. So we talk about, okay, who is going to buy your business? We can break those into three buckets. So generally there's companies that are operating in your industry. So they are operating businesses. They could be competitors. They could be public companies, private companies. They could be upstream or downstream from where you're at. But it's really, not a financial buyer. It's an operating buyer. And generally speaking, the strategic buyers are looking to acquire 100% of the business. So different from financial buyers, where they might be looking for a partnership or rolling equity or second bite of the apple. But strategic buyers are really looking to consolidate you into their business model.
Mm-hmm. That's an important consideration, because a lot of people that own businesses, there is a legacy aspect, and they have to decide, do I want my business to continue on? And I know when I've been approached, unsolicited approach from private equity or buyers, they always stress, you get to keep running the business the way you run it, same name, nothing changes. You won't even notice we're there. We just have a percentage, all they're really pushing that. Whereas a strategic buyer says, well, we're going to gobble you up and you'll become part of us. So if an objective is yours is that legacy, that would be very difficult with a strategic buyer, would it not?
Yeah, but money talks, and
That's right.
so and so a business owner might have, again, every business owner, their heart in this thing is a little different. But at what premium, would you be willing to walk away from? So if your best offer from a PE group is 20% less with a seller's note and an earnout, where strategic is saying, hey, all cash offer, $20 million, where the PE group's at 15 million, and you may say, well, that's a gap.
Yeah.
And maybe, it's, well, I really want to take care of my team. Well, we can talk about ways to, take care of your team with, loyalty bonuses and payouts, to where your team member can get very excited about working for a strategic as well. Yeah, and then just pivoting here to private equity, and I'm not, I know thousands of people that work in private equity. We've done many, probably upwards of 100 transactions, most of them with private equity funds. So I have a phenomenal network in private equity, and I would say that one comment is you cannot categorize all private equity as the same. There is just private equity. I mean, think of it as it's vegetables, right? But there's a big difference between a potato and a tomato, right? So you really need to do your homework on, okay, well, what is this private equity's, what's their track record? How do they treat companies that they acquire? How do they treat management teams? What kind of benefits do they offer employees? Do they have stock option programs for employees? Have they done other transactions in my industry? Have they been able to scale and sell businesses and hit their financial returns? Do they have a successful track record? So really digging into the background of the private equity buyer is really what we do. So in a typical transaction, we could have 4 or 5 private equity buyers that are interested, but then we help to do, hey, what are the background checks and really the investigations that we need to do into these PE groups, just so we know where they come from. Another really important point, and kind of the average business owner is just not going to know, understand this is the difference between a funded private equity firm and an unfunded private equity sponsor. So a funded private equity firm is someone they've raised capital. So they have a fund, fund 1, 2, 3, 4, 5, and that capital, that cash is literally sitting on their balance sheet. An unfunded sponsor is really a private equity investor that is looking for investment opportunities, but he has not raised the capital yet. He's just saying, I know people, I have friends, I have partners, I have people that have told me they would give me money if I bring them something interesting. I have a lot of relationship with family offices. So to ask that question, ideally you're working with an advisor and that advisor is doing this vetting for you. But if you're out there on your own and you say, hey, are you operating out of a fund or are you an unfunded sponsor? Every unfunded sponsor is going to say, oh, we're unfunded, but it's better than being funded because of blah blah blah. But I mean, there are some very good unfunded sponsors. We've done transaction with unfunded sponsors, but there is an added element of risk, and you really need to manage that risk. If you're going to get to an LOI and move into due diligence.
Yeah, my real estate analogy is every time you get a postcard saying I'll give you cash for your house, that would be an unfunded sponsor who wants to get interest, and then I'll go find somebody with money when I offer you half what it's worth. So yeah, you got to be very careful with the unfunded.
Yeah, and then I think the other thing, and we're just working with a business owner right now, and going through this very issue. But is the private equity sponsor? Are you the platform investment, or are you an add-on investment? So in an add-on investment, that means they already have maybe a handful, 1, 2, 3, 4. I mean, it could be even 10 plus, but they've done acquisitions, and so your company is just becoming part of a larger platform. Or are you a standalone investment or the initial investment, and then they would go do add-ons or add sister companies to your company, as a growth strategy. So really understanding, asking the right questions to the private equity groups, whether you're going to be an add-on or a new platform is another very important distinction.
Yeah, as far as related buyers, we could spend an hour just on that. Easy. Partner buy-in, management buy-ins, family. Oh yeah, that can be a big topic, and often it is a topic. It might be you want to sell to your family, but that's fine. But we're gonna have problems that you're not going to get a check necessarily, and it's still, even though you think you sold your business and you're retired, did you really? Are you really? Because you have to know you're getting
That's right.
checks.
Take
And
the seller's note, and then you
yeah,
end up
take your kid's note.
So
What's
Brian,
that worth?
before you jump on, I do have this term here called a search funder, and it's worth noting there are hundreds of search funders in the market right now. So and again, search funders, it's very complicated. They can be both funded and unfunded. But a search funder is really an owner operator who's saying, look, I want to buy one business. I want to be the CEO, and I have capital partners are going to help me with this acquisition. So there's a lot of search funders out there. There's pros and cons of working with search funders, and I think just email me if you're talking to a search funder, and I'll be happy to walk you through the pros and cons.
Yeah. With that, we'll go to I found this chart interesting. What I found interesting about that is if I look at 14%, immediately my brain goes to, well, that's an EBITDA of 7x. Okay, so when we're looking at private equity, and you mentioned some of those multiples, it might be 3 to 5, I mean, might be 5 to 7, might be 7 to 9. Seven's kind of in there. As a buyer, certainly if I'm private equity, I'm not satisfied, as I mentioned earlier, with a 5 to 10% return. I want to know, because there's uncertainty with buying a business, that we're getting a higher return, and I would expect as an investor that we can grow that net income over time. and make the firm, the company even more valuable. But I found this kind of interesting from that aspect, converting some of the average returns to an EBITDA calculation. Any comments you have on that, John?
Sure. So, the mindset of a private equity investor is we want to buy a business, we want to grow it, and we want to sell it. So
Mm.
I've never met a private equity fund who's saying we're going to improve your margins by, laying off staff and cutting costs, right? That's just never going to generate enough return to justify the investment. So every private equity investor is really saying, what are the growth drivers, the growth opportunities? And typically and ideally, private equity investors would want the owner to co-invest and roll equity or hold some equity in the business after the sale. And think about it, they don't want to, no one knows the industry better than you do, and they don't want to run this business, right? And even in a period of 90 days of due diligence, there's just going to be so much so much risk in the business that they're never going to understand. So the only insurance policy that's available to them to protect against that risk is really to say, hey, at least if I'm partners with the owner and the owner still owns 10, 20, 30, 40% of the business, I have some assurance that they have now we're evenly yoked as business partners, and that owner's got my backside as we execute on growth strategies. So from the business owner's perspective, and again, this is a wealth management conundrum for you, Brian. So if I'm going to roll $2 or $3 million of cash into a holding company or a platform private equity, what is my expected outcome or my expected return on that investment? And so this is, again, it's one dot. There's obviously a range of this, but on average, cash on cash return invested in private equity funds is getting 14%. Or, I usually tell my clients that if you're going to roll equity, you could be looking at say a 3 times return. I mean, obviously more is better, but really a floor of a 3 times return on the amount of cash that you roll with a private equity firm.
Yeah, that can be as a seller, that I've worked with some sellers of businesses where they sell the business, they get a big check up front. They get some equity in the consolidated business, the buyer, and then they have an employment contract for a number of years for the transition. So it's a really nice combination where often they can make sizable gains on the new stock, as well as they took the security of the cash flow or of the initial buy up front, and they have the additional security and kind of the legacy of continuing on to transition them. So it can be a really nice setup situation with that.
Yeah, and I mean, in the next webinar, we could talk about that second liquidity event and how you kind of model that, and also from a tax perspective.
Yeah.
Yeah. So this is just maybe just two more slides here on private equity. This one is really informational, and it's just to show that over time the amount of money that's been invested in private equity funds continues to grow. So right now we're sitting at $1 trillion, nearly $1 trillion of cash that's sitting on the balance sheets of funded private equity firms. And again, that's why private equity firms are so active in the purchase and sale of privately held businesses.
Right. And then you talked about adding value. It's kind of been a recurring theme about the buyer is going to want to know they can add value, that it's worth X today. Yeah, we're willing to pay a certain amount. But what is going to happen going forward? Can we make that even more valuable? Maybe you could start discussing some of these points.
Yeah, sure. So again, I have a running joke with one of our clients that he's the growth stop officer, and really that having the financing that's not guaranteed, by the business owner at the bank, right? It's like, hey, and I asked this question, hey, if you could spend $1 million, how, to grow this business, where would you invest that money? And well, if we had $1 million to spend, I would, I'd hire, two more salespeople, or, we would open, a satellite office, or, we would invest in product development. So really, partnering with private equity can give you that budget to really invest in growth. The private equity firms that we introduce to our clients are always from industry, right? So they're familiar with the industry. They understand, maybe they have other investments in that industry. So we're not really teaching them about, how that industry operates. And at some point, they actually are going to say, well, hey, we have customers that we could introduce, or we have experience developing technology, or we have experience improving margins through maybe manufacturing efficiency. So they're really bringing some knowledge to the table. Often you look at your leadership team and ask, well, what's missing, or who would you add to your leadership team? So having someone that could bring in maybe a fractional CFO or a head of sales, they have some relationships. Again, they manage the balance sheet, and then can bring, they have a bigger vision for your business in terms of doubling or tripling revenue, ideally, than you might have as a business owner.
Another thing that they can bring is, as they consolidate businesses, generally speaking, you mentioned a slide earlier, if you're under $1 million EBITDA, that can make your business not worth as much as it might be if it was bigger. And so the bigger the group of businesses, often you mentioned that one of the objectives of a buyer is they're going to buy it, improve it, and sell it. When they sell it, they want to pair it with other, a bigger business, and their valuations are even better than what they're paying. Would that be accurate, John?
Yeah, that's right. So, a 3 million EBITDA business, in the same industry, the EBITDA multiple, again, hypothetically might be, 4 to 6, but if it becomes part of a 20 million EBITDA group, the exit multiple could be, 8 to 10 or 10 to 12. So that's where, if you're rolling equity and then your business gets revalued as part of a larger group, you're going to make that 14% annual return on the equity that you invest.
Yeah, and another analogy here is the stock market. The stock market historically trades in the upper teens, 20s times EBITDA, essentially. So enough uncertainty has been taken out of that, where people are willing to accept much lower yields for diverse, publicly traded companies in the stock market. So they have very high multiples relative to buying businesses which have a lot more uncertainties. So as we go to the next slide here, talk about the deal flow.
Yeah. So just, where are we in the market? I mean, it's funny. I thought, 2018, 2019, 2020, I mean, obviously, COVID hit us all on the side of the head, but I was pretty happy in leading up to COVID. 2020 was the down year, and then we had the big rebound year with kind of all the liquidity and COVID going away. 22 and 23, we had a rising interest rate environment, so valuations slipped a bit and volumes came down. And 24 is looking to be an improvement on 23, but even 23 being down, it was still higher than 2016, 2017, 2018, and 2019. So we talk about it as a down year, but it was actually still relatively a strong year. So again, this is the amount of deal value that private equity is the aggregate of M&A transactions, and then the number of M&A transactions in the U.S. So they're, understanding private equity. If you own a business, there's pros and cons. working with private equity, but really understanding it at a deeper level is part of that journey. And that's what we do. We love to answer questions and answer any, explain anything that a business owner would like explained.
Yeah, another thing behind the scenes of these numbers is one of the reasons I wanted to do this with you, John, this webinar series, is that the average age of baby boomers, and baby boomers own most mature businesses, is in the late 60s right now. So I see nothing but increase in the future because people want to retire eventually. They love their business, but they're getting a point in their life where they understand it's finite and they need to make a change. So, well, I think we'll just see an upward movement there as far as the number of businesses available. Sounds like there's plenty of dry powder out there, and if they want to get the deal done right, you've shared some really good slides here today, John. Thank you for that. Really important stuff here. So as we kind of come to the end,
yeah, throw it out to Q&A.
Yeah.
If anybody has any questions, would love to answer them.
And on this slide here, we'll wait to see if there's any questions coming. On this slide, QR code, and certainly if you want some more information from Chinook Capital Advisors, please click on that. These are some of the topics we've been covering in the other webinar versions in this series. Here's another one. I put together 98 videos, short, 4, 5, 6 minutes on 98 topics, stuff that comes up over and over in the investment advisory world, the income tax, estate tax planning, legacy, business succession, real estate succession, all those topics. So if you have topics outside of pure business succession, which I would send to John, of course, you can get educated there. And if you want to email one of us, here's some emails, and you can send us something there. And we look forward to here's one more you can click on. Upcoming on June 20th is the tax planning and reinvestment opportunities from the sale of a business. I'll probably have more comment in that than the first three have been focused on John's expertise. This will be a little bit more on my own, and I'm told that I need to put a disclosure up here to get to that. I did have one question that came in, John. Could we share, or you share some more thoughts on search funds and how owners of selling businesses perceive them?
Yeah, sure. So, a typical search funder is, he has a solid resume, right? So maybe he has a master's, he has some work experience, but they've come to a point where they want to leave kind of the Fortune 500, Fortune 100 world and become a business owner. So they're really looking to identify a business, acquire it, and run it. And they can be funded in two different ways. So one is they can join a search fund group that has raised money, and so they have, let's say a couple dozen owner operators that are out there trying to find businesses. And if they find that business and they can agree to a reasonable valuation, they have the capital standing behind them to close the deal. The other would be an unfunded search funder where they really haven't solved the capital equation yet, but what they want to do is talk to a business owner, get him to sign the LOI, and then they will go figure out the capital. And that's really the situations which can be challenging for a business owner because you're under LOI, you can't talk to any other buyers, but then you're a little bit in the dark in terms of, hey, is this deal really going to happen? And so we've seen some very frustrated experience of business owners who end up burning a lot of time with search funders only to be disappointed if the deal doesn't close. And then again, generally search funders are On the pro side, they're very personable. They're very relationship oriented. And on the con side is there's no synergistic value in their valuation. So it's going to be I would say a low to a mid tier valuation compared to maybe other buyers that can have strategic value.
All right. Well, thank you for that, John. With that, I'll wrap it up. Look forward to, I want to thank you all that are on here for coming on and listening to us. Invite you back on Thursday at noon, and we'll do this one last time, number 4 in the series of 4. So again, I appreciate your time very much, John. Thanks for being on
Yeah.
here. Thanks to everybody that tuned in today. And with that, we'll sign out. Thank you so much.
All right. Yeah.